right, it's 11:31, so let's get started. Again, my name is Mike Camara with Bogart Wealth. This webinar or this presentation is around net unrealized appreciation, or NUA for short, and other post-retirement strategies around that. So a little bit about us as a firm. Bogart Wealth is a registered investment advisory firm. We work as true fiduciaries. We have about 2.9 billion of assets under advisement. We work with roughly 1,200 households, and we custody with Charles Schwab. We don't hold any money directly at Bogart. We're a fee-only wealth management firm. We don't charge commissions. We don't have those types of incentives here. These are our advisors. There I am. I've done this almost 19 years. I'm a certified financial planner. You can look at any of our people's bios on our website. This is some of the rest of our team. I'll go through this a little bit quickly. So more of our team. Again, you can read anyone's bios on their website. Our portfolio investment team. And 3 office locations. I'm in the Woodlands. We have a Houston, Texas office, and then our main headquarters is in McLean, Virginia. So basically, when we look at planning, we treat retirement planning as something that's never done. We typically like to go through a process of doing a retirement analysis, looking at cash flow and withdrawal strategies, tax planning and tax optimization. From there, we build out an investment strategy, look at estate planning, trust reviews, wills, power of attorneys. How do I pass on my assets? We review and monitor, and then we can do it all again. So we treat retirement planning as something that's never done. We like to revisit the analysis at least once a year, revisit the cash flow strategies as that changes. Tax laws will change eventually. Investments need to be adjusted. Estate planning laws can change, so we need to tweak there, and then we're always reviewing and monitoring. So it's a circle for a reason. We don't just stop at one point and say, okay, good luck for the next 30 years, hope it works. Retirement planning, again, is something that's never done, even after you retire. So this is part of our retirement readiness series. We're here with NUA and post-retirement strategies. We've also got the retirement planning timeline, retirement income planning, Social Security, tax planning, tax law changes. That's obviously more relevant when we do have major tax law changes. Estate planning, long-term care, Roth versus traditional, 401ks and IRAs, and my personal favorite, the mega backdoor Roth strategy. So the agenda for today is to get into net unrealized appreciation, probably one of the more complex topics that come about when it comes to retirement planning overall. And then, with NUA, how that fits into post-retirement strategies, estate planning, tax strategies, and cash flow strategies. We'll also touch on good till canceled orders, which pertain to basically liquidating a stock, and covered calls, which are options. Again, for Q&A, I've got the chat going, but basically just, put in any questions and I'll get to it by the end of this presentation. So first of all, let's break down the difference between a retirement account or a qualified account and a non-retirement account or a non-qualified account. Just semantics, means the same thing. So most people think 401k when it comes to a retirement account, and most of this discussion will be pertaining to 401k plans. That's what NUA is driven by. So good part, salary is typically contributed on a pre-tax basis, which means that you save taxes every year while you're also saving for retirement. Comes off your gross pay. Pay no taxes on the gains or appreciation until it's withdrawn. You pay no taxes on any interest or dividends. And a lot of times you receive a company match, not always, but with the 401k plan, a lot of times it's good to start saving there, primarily because of match. But the other part is that there's a tax penalty of 10% if money is taken out early. That's typically under the age of 59 and a half. Every dollar, both the original cost and the appreciation, will be taxed as ordinary income when you take the money out. And basically, you have to take out every dollar during retirement. What that means is the government enforces what are called required minimum distributions, starting at either age 73 or 75. That varies depending on your date of birth, meaning that if you don't need the money, and you want to defer it, pass it on to beneficiaries, the government will force you to start taking it out in your 70s and essentially pay taxes on it. So if you don't do those RMDs or required minimum distributions, there is a substantial tax penalty for failure to withdraw it. So withdraw it. And the custodian that you basically have your money with is under legal obligation to tell the government if you fail to withdraw based on schedule. So non-qualified account, non-retirement accounts, more friendly way to say that, but good with that, or the other part with that is all investments are on an after-tax basis. You pay more in taxes every year, dividends, interest, all that is taxable whenever it's paid out, not when you withdraw it. Even if you do reinvest it, you will owe taxes on that. You pay taxes on gains or appreciation when shares are sold. So if you buy a stock for $5, it gets up to $20. You sell to make a profit. Even if you don't use the money for yourself, there is going to be taxes with that if it's reinvested even. So basically, there also is typically no company match when it comes to setting up your own personal non-retirement account. What's the good part? No such thing as an early withdrawal. You can access the money how and when you want to. There's no required distributions, and any appreciation will be taxed as capital gains as long as the stock has been held longer than a year. It's considered long-term. If it's sold within a year, it's considered short-term and taxed at marginal tax rates. Long-term capital gains rates are typically 40% lower, though, than ordinary income tax rates. And that's kind of the key concept here when it comes to NUA, basically the difference of capital gains tax rates versus ordinary income tax rates. More to come on that. So NUA, what's the deal with that? Basically allows a do-over. It doesn't really make any logical sense as to why this is available. It's kind of waving a magic wand and doing a reaccounting. But basically what it is moving assets from retirement accounts or 401k qualified to non-retirement accounts, basically non-qualified. Tax rates are going to vary then as far as capital gains versus ordinary income. Caveats to that is that it only applies to employer stock in a 401k plan, and that's it. It doesn't apply to anything else. It can include stock received as company match, though, and you can choose which dollar range of shares you want to declare NUA on. More to come on that. It must be part of a lump sum distribution from the 401k, which basically means that you've got to take everything out of the 401k. It needs to be the first distribution that you do since a qualifying event. That's separation from service after age 55, attaining the age of 59 and a half, falling into disability. And again, you must remove everything from the 401k. Anything that you do not take as NUA can be rolled over to an IRA. But again, nothing can be left in the 401k at the end of the calendar year that you declare NUA on. So why is it called NUA? Again, it stands for net unrealized appreciation. What it actually is the current stock value minus your cost basis or what you paid for it. That equals your NUA. So again, cost basis, let's say you bought a stock for $5. The current value is $20. Your NUA would be $15. So there's a tax benefit for distributions from the employer's stock utilizing NUA. The lower the cost basis is, the better. The higher the market value, the better as far as NUA opportunity. This is just a little snapshot of how it works. Basically, your NUA shares would go into a brokerage account. Everything else, if you took it out of the savings plan, would go into an IRA. What is taken out of the savings plan would remain tax deferred. So the qualifications, only allowed to use NUA if you receive the employer's securities as part of a lump sum distribution. This is just reiterating again, you get a one-shot deal. You can't do it over 2 or 3 different segments. It's one shot and then that's it. It doesn't allow for any do-overs. Again, you have to take out the entire balance within a single tax year. And the first distribution, it must be the first distribution after a qualifying event. Again, the 4 qualifying events are: you separate from service due to disability, you separate from service after the age of 55, you reach the age of 59 and a half, or if you pass away and the 401k is inherited by somebody else. So this is just looking at a statement. We have an example of an ExxonMobil statement here. Again, this is only pertaining to employer stock. None of these other investment vehicles are eligible for NUA. And this isn't just for Exxon, it's for any company, BP, Pepsi, Apple, whatever. If you've got company stock in your 401k plan, NUA is an option. When you're looking at your statement, after-tax money, if it is in the 401k, is applicable to how you approach NUA. But looking at your statement, you got to make sure that you're looking at the right thing. This is not actually the after-tax balance as much as it says after-tax account. This is truly the after-tax amount. The delta between the two is growth. So said another way, anything classified as pre-87, post-86 contributions here, this 131,000 is basically what is post-tax money. That is money that's already been taxed. The delta getting up to the 278, that is investment growth. The growth on this 130 is considered pre-tax. So this is truly what your after-tax money, if you're looking after-tax money is, if you're looking at a Exxon statement. Again, just reiterating that here. So the options for the post-tax money, and this is where it applies to NUA. You can withdraw it. It's already taxed, so you won't incur any taxes on it. You can take out 130 grand to yourself. Again, no taxes on that. You can roll it into a Roth IRA. It's a good option if you don't have NUA available in your 401k plan. This has been an option since 2015. Again, can be better than NUA if you're not selling Exxon. Or if you do declare NUA, you can apply it to the cost basis to avoid taxation on that. More to come on that, basically, as far as the mechanics here. So again, if you're looking at your statement, this is looking at your stock cost basis. Will we receive either a copy of the slides or the recording? Yes, we will be posting the recording on our website. So yeah, that will be posted probably within the week after today. So reading your statement again, this is just looking at basically the stock cost basis. The lower the cost basis, you can see there's some very low shares that were bought here. Lower the cost basis, the better when looking at this stuff. This is also just looking at current payroll contributions, so contributing on a 15% pre-tax basis. This is where after-tax monies can come in. Basically, typically, if you max out on what a pre-tax savings is, you can have the option to spill over to after-tax savings, which is typically how most people build up after-tax monies. Got another question here. If you're taking the quarterly dividends as withdrawals from your company's savings plan accounts, are those withdrawals considered distributions? No, that's actually not. Common, very good question. I remember I got thrown first time I saw that, but no. Qualified dividends or quarterly dividends coming from that is not considered withdrawals. So again, reading your statement here, there's different ways you can save into the 401k plan, pre-tax, Roth, after-tax, or you can do catch-up contributions, excuse me, if you're over the age of 50. This just looks at your investment elections. So, if you're buying into Exxon stock, right now the price is obviously very high compared to years ago. Basically, this is 5% going into Exxon, 17 of payroll going into equity units, 30 extended, 25 international, 5 bond units, 18 balance fund. So it just gives an example of the options that you can invest in the Exxon 401k plan. This gives an illustration of basically how the savings plan would be distributed a little bit more clearly. So if you have some Roth monies basically in your Roth 401k, you want to move that to a Roth IRA. Anything that's not pertaining to Exxon stock that's pre-tax money, so think common assets, equity units, balance fund would go into an IRA. Any pre-tax monies basically. Any Exxon shares that you do not declare NUA on, you can actually move those in kind and put them into a regular IRA. Core means non-managed. You just kind of stick them in a IRA and hold them there. You can sell them at your will, basically down the road. And then, as mentioned before, any NUA shares that you declare or any Exxon shares you declare NUA on would need to move into a brokerage account, individual, joint account, or a trust account here. This is just an illustration, dollar amount wise, and we'll come back to this as far as giving more examples. But again, if you had around 5,000 shares you declared NUA on at $100 per share, about 500 grand going into a brokerage account. If you declared on 5,000 shares, but an extra 500 shares are too expensive to declare on, that would go into a regular IRA, and then everything else would roll into regular IRAs or Roth IRAs, depending on the classification of money. So if you get anything from this seminar, this is probably the most critical thing. It explains, there's a lot of complexities when it comes to NUA, but this, I think, explains it the best as far as the base case of not doing NUA versus doing NUA. So let's say you take a distribution from your 401k plan or IRA. Basically, 100% of that distribution would be considered ordinary income when you withdraw the money, not when you sell the stock. Again, if you sell the stock within an IRA and keep it there and just reinvest it, no taxation on that. But whenever you pull the money out, that's where it's taxed as ordinary income. With NUA, the cost basis is still considered ordinary income. So in the example of $5 per share, that $5 per share is still considered ordinary income when you bought it with pre-tax money. But if it's worth $20 a share, the gains, again, $15 of gains, would be considered NUA and can be taxed at long-term capital gains rates. So in an example of this, we're going to get into, it's $500,000 that you can take out or declare NUA on $500,000 worth of stock and only have basically a basis of $100,000 with $400,000 of gains, and having that gain taxed at a capital gains rate versus an ordinary income rate. So this is just a comparison of ordinary income tax rates versus capital gains tax rates. You can see on the low end, on the high end, capital gains rates are typically lower than ordinary income tax rates. So when we're looking at the cost basis, this is one of the key things to understand. Let's say your cost basis is $29.50 per share on average. The number of shares is 5,000. Your total cost basis is $147,500. In the previous example, we had $130,000 of after-tax money. This is where it gets a little tricky. Forgive me, it's a little complex. Feel free to throw in some questions, but let's say this after-tax money was zero. If the after-tax money is zero, when you declare NUA, even if you're not using the money or selling the stock, you will immediately have to report the cost basis as ordinary income. So you would declare NUA and have to report income of about $147,000. Now, then you would owe taxes on that. So you have to make a taxable payment or an estimated tax payment to account for reporting in the quarter $147,000 of income. Essentially, though, if you have this after-tax money of $130,000, you can apply it to the cost basis and lower what the taxable portion would be. So in this case, you apply the after-tax to the cost basis. Instead of reporting $147,000 of ordinary income, you're only reporting $16,584 of ordinary income. And on an estimated federal and state tax basis of 40%, you owe $6,634. Now, what happens to that after-tax money when you apply it to the cost basis? It doesn't just disappear. The easiest way to conceptualize it is that after-tax money converts to pre-tax money, and down the road, whenever you withdraw that money in your 401k or in your IRA, then you owe taxes. So it's basically deferring the tax bill. Now, you don't have to do that. You can just pay the taxes and roll it over, and roll the after-tax money over to a Roth. But essentially, that's where the after-tax money comes into play with this. I got another question here in the Q&A. And I'm sorry, I'm not seeing the chat here. Might be something with my Zoom settings. So if you have any questions, please put it in the Q&A here. You mentioned the 4 qualifying events for NUA. Is there a back end by which it has to be done if you don't have a need to take any distribution from the 401k? No, you can do it at any point. I've got people that have done NUA 10, 15 years after retiring from their employer. So there is no end date. The only thing is that you can't take any money out of the 401k unless it's those dividends that I mentioned before. If you do take a distribution, like at age 59 and a half, that's pretty much, for most people, the only qualifying event they're going to have outside of death and disability. And, we don't want those, obviously. So no, there's no back end as long as you don't take any money out. But if you take any money out, say right after you turn 59 and a half, in order to declare NUA, you got to get it all out of there before year end. Another question here. Let me scroll down. Can you clarify what the 3.8 is in the capital gains tax rate? That's Obamacare surtax. Essentially, if your AGI is above 250, instead of a 15% capital gains rate, you would have an extra 3.8 added on that for 18.8%. Where the 139.16 after-tax money go after the NUA, mentioned that already, it converts to pre-tax money. It doesn't disappear, it just goes from after-tax to pre-tax money. All right, so then this is basically the tax on the capital gains when sold. So value of the shares, again, is $500,000. The taxable cost basis, again, is $147. So let me just jump back one. Again, cost basis $147. Even though you applied the after-tax money to the cost basis, that doesn't change the cost basis. And so essentially you have a cost basis of 147, which means that you've got a gain of about 352. So at a 15% tax rate, you're looking at a $52,875 bill. Now, also, this is a little bit of a nuance. NUA shares are actually not subject to that 3.8% capital gains tax rate. So kind of keep that in mind too. Now let's look at the net proceeds with NUA. So gross proceeds from the sale, 500,000. Tax paid on the cost basis with the application of the after-tax money is about 6,634. Tax paid on the capital gains at 15% is 52,875. The net proceeds with NUA is 440,491. Now let's look at the net proceeds without NUA. Let's say you just took out 500 grand. You had a 40% tax rate between federal and state taxes. The net proceeds without NUA is about 300,000. So when you're looking at the benefits of NUA in this example, and everyone's tax rates will vary, but nonetheless, the net proceeds in this example with NUA is about 440. The net proceeds without NUA, meaning if you don't do NUA, is about 300,000. So you get a benefit of about 140 grand in this example by declaring NUA and utilizing the money in that fashion. I think I had another question or two. I just retired and ExxonMobil automatically sent me my non-401k balance of the savings plan with tax withheld. Which tax paid portion does the slide reference? That's not after-tax money. That's probably a non-qualified payment. The SSP, Supplemental Savings Plan, they automatically pay that out. That's a completely different thing. That's a non-qualified plan. Has nothing to do with basically this. The tax paid portion is actually within the 401k. If you look at your statement, it'll be on page 3. Any pre-86, post-87, pre-87, post-86 contributions found on page 3. Let me go back a little bit here. I was on slide 33. Let me get to the statement example again. Right here, this will be on page 3. This is where you can find your after-tax balance. And again, it has nothing to do with the SSP. That's a completely separate entity, if you will. All right. Can we take money out of the general account company match and treat as NUA? Yes, you can. So yeah, company match counts as that as well, that you can utilize for NUA. Proceeds from the sale of NUA stock, can you then move them to a Roth IRA after you've paid all the tax liability? No, you cannot. Is there a sweet spot where NUA is not desirable due to immediate tax liability? In my case, most cost is 25% total value. I have come up with 10K. That's something we got to just look at more on an individual basis. So that's something if you'd like to explore, reach out and we can look at that for you. Clarification on qualifying events. If you had a withdrawal after retirement and before 59.5, doesn't the 59 event reset your ability to take NUA? Yes, it does. So for example, the example of leaving a company at the age of 55, there is a tax law that if you leave a company in the year after you turn 55, you can take money from your 401k and avoid a 10% penalty. So I believe, Charles, in this example, if you take out 10 grand, let's say at the age of 57, if you don't declare NUA within that year, you can't do it again until 59.5. But yes, once 59.5 rolls around, even if you took money out at the age of 57, that resets your ability to take NUA, and 59.5 or later at any point, you can declare NUA. But again, at 59.5, if you take 10,000 out and then wait 3 years to declare NUA, you won't be able to do it. So it's got to be within the year that you take your first distribution. So be very careful if you have NUA before you get that distribution. No, the SSP was a separate payment. So I'm not sure then what that would have been as far as that after-tax payment. So yeah, typically that's in relation to the SSP. So I wouldn't be sure on what that was. All right, so factors favoring more NUA. Basically, if Exxon's share price will rise in the future or has risen recently, like we've seen in recent years, plans to use NUA sooner, expected large purchases, the, wanting to get cash flow and save on taxes on the early end. If you've got a lot of RSUs that are still vesting, you're going to, even after retirement and salary going away, you could have still some, higher taxes overall in those early years of retirement while those 3 and 7 year vesting schedules kind of dry up. And then retiring prior to age 59 and a half, you can use NUA as a bridging strategy, or you expect that your RMDs will be pretty large as you get to your 70s. That's something that basically you can declare NUA to move some of that money from being considered as part of your RMD to being put into a brokerage account, which again, if you remember from previous slides, that has no impact or consideration when it comes to RMDs in your 70s. Factors favoring less NUA. Exxon share price will fall in the future. Gotta be careful that you don't declare on too high and have basically the Exxon stock go below what you declare it on. Or if you don't plan to sell the NUA shares, you're getting that tax hit on the front end, especially if you don't have any after-tax money. I would also say not necessarily no plans to sell the NUA shares, but also if you had plans to just sell them and reinvest them. Again, if you sell them and just reinvest them and you don't need the money, again, other factors aside, basically you're paying capital gains taxes, you're paying taxes on the cost basis. Whereas if you sell them within the IRA realm, if you will, there is no taxes. You can reinvest, you can do whatever you want. So I would also say if you do plan to sell them, but just plan to sell them to reinvest it. Typically, NUA shares are used for funding living expenses in the earlier years of retirement. Or if you have a preference for after-tax contributions to go into a Roth IRA, I would say that you could still apply to the cost basis and do a Roth conversion and just be a little bit more tactical on how you basically pay taxes on that. But some people want to get as much money into a Roth as possible. And so that goes against NUA and utilizing the after-tax money there because that can be rolled over again into a Roth. So again, some advantages and disadvantages here. Advantages are for NUA, it's tax and long-term capital gains rate, not subject to the RMD rules, never subject to a 10% early withdrawal penalty, and can offset tax on cost basis with the after-tax money, as we discussed. Disadvantages are cost basis is taxed at ordinary income rates. There's no benefit of tax deferral on any future growth. That's again kind of talking also about just selling it and reinvesting it. You're not really getting any benefit by doing that. Matter of fact, you're paying taxes somewhat unnecessarily with that. A significant amount of employer stock leads to a less diversified portfolio. So again, if you declare a lot of NUA, you got all this Exxon stock. That kind of gets back to my point. Trying to diversify out of that is going to cause you to have taxes. Better to diversify within the IRA, within the 401k than declaring NUA, selling it and diversifying and getting clobbered with taxes. Dividends are taxed at your qualified dividends rate annually. So if you do basically just hold on to those shares, those dividends would be paying out and you would owe taxes on it since it would no longer be sheltered within an IRA. I think I got maybe one more question. So if you choose NUA, you must empty out your 401k from Voya. Can't leave your money there. Yes, that is correct. All right, so we're going to get into now some pre-retirement strategies, just kind of teeing up some of the stuff that we talk about further from here. So we're going to review pre-tax versus after-tax savings, NUA share cost basis versus tax paid. Saving more, carefully consider before selling low basis shares. Sorry, I misspoke there. So again, just to review, pre-tax versus after-tax savings is important as far as classifying what money is within your account. Make sure you're looking at the right place on the statement. NUA shares, we have an analysis we can do to kind of review all the shares within the ExxonMobil plan. Unfortunately, they keep track of every share you've ever bought and what that cost basis is. Always, consider saving more and carefully consider before selling the low basis shares compared to the high basis shares. Whenever you sell Exxon shares within the 401k plan, double check this, of course, with Voya. But the way it's set up now is that they sell your most expensive shares and work your way down, since NUA is such a large part of retirement strategies with Exxon. All right, so we're going to get into now a little bit of estate planning, tax strategy, cash flow strategies, good till canceled orders, which is just like what do I do with the Exxon stock once I have it, once I've declared NUA, and covered call strategies involving options. This is stuff that you want to do after retirement. Can't do option strategies while you're an employee of Exxon. So estate planning, beneficiaries can also enjoy the NUA tax strategy. Heirs would pay long-term capital gains as opposed to ordinary income. So typically with NUA shares, if you pass away 30, 40 years later, there will be a step up in basis, but technically speaking, NUA shares do not get a step up in basis, but in 40 years, most people are not going to remember that these are NUA shares. And so you would probably get a step up in basis, but technically speaking, if you declared NUA, if you passed away very quickly, there would be no step up in basis for that. And I'm going to skip over this one. Now we're going to get into cash flow planning for early retirement with NUA. So basically, when you're looking at cash flow, how am I going to generate income? Types of income are Social Security, pension income, interest income, IRA and 401k distributions, dividend income, long-term capital gains, money out of a Roth IRA, which is typically tax-free, and liquidation of investment principal. The taxability with Social Security is it's partially taxable depending on your income. Pension income is ordinary income, as is interest, as is IRA distributions. Dividend income, qualified dividends like Exxon is taxed at long-term capital gains rates, which is typically 15%. Long-term capital gains rates are taxed at long-term capital gains rates. Roth IRAs, again, not subject to taxation as long as you have attained the age of 59 and a half and the first money into the Roth is over 5 years old. And then a liquidation of investment principal, if it's a non-retirement account, there's no taxation. So the considerations for minimizing tax liability: hold assets to generate interest income in qualified accounts. So that's IRAs or retirement accounts. Hold assets generating dividends or capital gains in non-qualified accounts because those are taxed at lower rates, as you can see. Use distributions from different account types and different assets. So every account type is different. All these have pros and cons. I love when I have a good amount of money in non-retirement. Pre-tax and Roth money gives me a lot of flexibility that I can work out for strategies in given years and different goals and different tax rates. And overall, focus on maximizing lifetime after-tax income instead of minimizing the current tax bill. That's just saying, play the long game with taxes. A lot of people like to save taxes as much as they can every single year, but then that can cause some longer-term tax issues, especially when it comes to required distributions in your 70s. So once again, this is just re-illustrating the long-term capital gains rates and qualified dividends rates. So if you're joint, if you have no other income, nothing else, up to $96,000, $700 is not even taxed. Then if you fall in this range, you get to 15%. Above 250, you have the Obamacare surtax. Again, doesn't apply to NUA shares, but regular long-term capital gains it does. And then over 600,000, most you're paying is 23.8. But again, compared to ordinary income taxes, having income over 600,000, this isn't a bad deal. All right, so what do I do with my Exxon stock once I have it? So one of the ways you can divest it is to do what's called a limit order or a good till canceled order. Very simply put, you set a price target for Exxon that will automatically sell if it hits that price. So for example, if you want to set a price target to sell 100 shares, if it gets up to 125, you set the limit order, 125, 100 shares. You sit back and just hope it happens. You don't have to monitor it. You have a good till cancel means it's going to go until you cancel it. And then essentially, if the Exxon stock gets up to 125, it'll automatically sell at that price and you'll liquidate those 100 shares. Now, of course, if it never gets up to 125, it'll never execute. You can do a market order then and just sell it at the current price. But a lot of times we look at setting a price target in order to liquidate the shares at certain price points. So now we're going to talk a little bit about covered call strategies. I personally prefer to use limit orders to get out of Exxon stock. Covered call strategies are kind of a way to also get a little bit more dividend out of the stock or a little bit more yield, essentially. There's a strike price, a time frame, a premium, and the underlying price. So the strike price is basically where the stock has to get to before it gets called or sold. I'll get into that a little bit more. The time frame is how long the option is good for. The premium is how much you get for writing a covered call, and then the underlying stock is Exxon or anything else. So when a stock investor sells a call option against their shares, they're basically accepting a premium as payment for giving up all upside potential in the shares above the strike price. In other words, by selling a call option against 100 shares of stock, you're selling the profit potential on the shares above the strike price of the call you sell. So basically, if the strike price is $100 and you get paid a $3 premium, you receive that immediately. So you agree to at the strike price, possible sale price of 120. And then you have one call equals 100 shares, 10 calls equal 1,000 shares. These are always done in 100 share increments. So basically, if it's $3 premium, 1,000 shares, you get a $3,000 payment for selling this option. There's two outcomes that come from this. Stock will stay under $120 through the expiration date, which can be 6 months, it can be 2 years. But if it doesn't go above 120, it doesn't sell, and you keep the $3,000. We keep the $3,000 here regardless, but basically it doesn't sell. If the stock price goes above 120 before or through the expiration date, be it 6 months, 2 years, then basically it will get sold at 120. Even if it's at 128, you have to sell it at 120, and that's where that risk lies, that if you just held it, sold at 128, you would have been better. Technically, you're selling at 120, you're selling really at 123 because you got that $3 per share. But that's where, like I said, it's good for generating extra premium, extra dividend, but it's not my preference for selling the stock if it, as far as that goes. So essentially, this is an example. Let's say the initial, value is $100. You got a $3 premium there. You basically do if the stock goes up to 125, it'll liquidate. If it stays at 120, you basically get a $3 premium, but you've lost out on $2 once it gets up to 125. So like I said, it's almost like selling it for 123 with whatever the premium is. This is looking at call options examples. Basically, this is the strike price, which is what it has to get to in order for it to be sold. If it's in the blue, it means it's already at that price or better. And then essentially, when you're looking at the premium here, you can basically get the bid. That's how much premium they would pay you. Obviously, they'll pay you more to be able to buy it at a lower price. And then as the price increases, those premiums that they're willing to pay drop down to the point where nobody's really offering above 115. And this is as of February 6th. This updates every day, and these premiums bounce around. So you just kind of have to look at where it's at there. So covered call strategies, the advantages are you can earn additional income while retaining the stock. You have some downside protection from that premium. It's a good strategy to divest the shares, but it's not guaranteeing that you're going to get out of it. Once you have that option set up, you can't really sell it or change it. You can sell it, but you're usually going to get hit on that. The disadvantage is that there's a cap on the upside profit. Again, if you agree to sell it at 120, it gets up to 200. You're missing out on a lot. You may be required to sell the stock if it gets above the strike price, and the downside protection is limited to the premium received, so it's not doing a whole lot as far as giving you some downside protection. $3 premium, if the stock goes to zero, not going to really help much. So basically, when we're looking at, some of the things that we discussed here, we invite you to come and speak with us. No obligation. We do a lot of complimentary analysis just to get to know you, see if you'd be a good fit for us. We'd be a good fit for you as advisors. What you want to have from an advisor is someone that's qualified and experienced. CFPs are pretty much the norm now. Knows your retirement plan, like the Exxon plan, knows IRS rules, has navigated multiple business cycles or been doing this for a while. Manages portfolios, open to discuss various strategies. None of this is perfect. There's always pros and cons. It's not the best fit for everybody as far as utilizing NUA. I've talked some people out of NUA where it doesn't make sense, and others where it does make sense. It's been a great bridging strategy. Provides financial planning based on your needs and risk tolerance, provides regular performance reporting, and understandable, speaks in a way you understand. Hopefully I do. Sometimes I don't. But again, we invite you to have a one-on-one financial strategy session with us. No charge for that. It's a complimentary service that we provide. And then basically, if you would like to contact us, go to our website, bogartwealth.com, and essentially click on the contact us. You can call us, and then it's got our different offices there. So thank you. I'm going to click through the disclaimers real quick. And one more. And I'll come back just to our contact info, and I'll see if there's any more questions in the Q&A. In the example where the net after tax was around 400 USD, can this entire amount be converted into a Roth? Is there no limit based on gross income? So yeah, you can convert whatever amount you want into Roth monies. There's no limit. The government will let you convert however much you want. Also giving up future dividends. Yep, if you sell the stock. What's the downside protection? Only $3K premium. Yep, that's it. That's why I said it's not much. Is there a specific form required to formalize a transaction as NUA? No, there's no form. Believe it or not, it's done over the phone. So you call Voya, they take your direction over the phone, nothing to sign, nothing to fill out. You just go over it. It is complex as far as what you need to tell them and all the ins and outs. But yes, there's actually no form. all done over the phone. You'll get some tax forms from Voya that you got to kind of put together with your, tax guy, which that's, half the battle in my opinion. But nonetheless, yeah, no forms. It's actually just done all over the phone. If I do paperwork for an NUA on day one, on which day does it actually execute? Typically the next business day. And there's no paperwork. It's done over the phone. All right. Well, that's the presentation. I'll see if there's any other questions that trickle through here. If I retire before 60 and want to hold the pension fund till 60, can I roll over 401k before pension lump sum distribution? Yeah, the 401k and the pension are completely separate entities. One does not impact the other as far as, doing something with the pension versus doing something with the 401k. Yeah, completely separate. All right, so I don't see any other questions coming in. Give it a couple more minutes and then pretty much done here. So yeah, if you don't have a question, feel free to drop off. And I'll stay on in case any others come through. Oh, another one. Can you repeat what you said about step-up basis for heirs on NUA? Yeah, typically speaking with NUA shares, there is no step-up in basis. However, in 40 years, if someone passes away, usually they don't remember that these are NUA shares and they just get stepped up anyways, but don't count on that. It's again, technically speaking, NUA shares do not allow for a step-up in basis. Appreciate that. Thank you. You're welcome. I'll give it a couple more minutes in case any other questions come through. Okay, I got one more. Is the deck available on PDF for us to access? I don't know if it is. Reach out to our group here. I believe it is, but basically, reach out to I believe it's Mindy who does this. Feel free to contact us, and we should be able to get it to you. But like I said, we will be posting this online. But definitely reach out to us. You can contact us, and we can get that deck to you. Yeah, I mean, it can be, yes. I mean, when you're looking at, even if NUA shares don't get the step up in basis, they still are going to be moved over to a brokerage account and be taxed at long-term capital gains rates versus ordinary income rates. If you keep it all in an IRA and you inherit the Exxon stock in an IRA, pre-tax monies has to be spent down within 10 years when it's a retirement account for a non-spousal beneficiary. So they would have to take it out over 10 years and pay ordinary income taxes. Where technically speaking with the NUA shares, it's a better tax rate because it's not ordinary income tax. You can sell it whenever you want to, pay the taxes whenever you want to. Again, the dividends will be taxable, but you're inheriting a bunch of Exxon stock. I'll take the dividends. I'll take the taxes as well if I get a nice inheritance. So essentially, yeah, it can be good for estate planning as well, irregardless of the step up in basis, because again, pre-tax money has to be spent down within 10 years. So if you inherit 2 million bucks, you got to spend that down within 10 years. So yeah. A couple more minutes, see if any other questions come through, and then I'll wrap up here. See anything else coming through? One more minute here. And again, feel free to reach out to us if you want to set up a one-on-one with any of our advisors here. We all know NUA inside and out and can look at your specific situation and better advise that way. Great. Well, thanks again, everybody, for joining. Oh, there you have one more. Let's see. Do you recommend to make some late career after-tax contributions to bump up the NUA value? Yeah, I mean, if you can save more, I think that's good. I would not necessarily save on an after-tax basis, just for NUA. I would actually, if you're at the end of your career, you're probably at your highest income bracket. I would max out on a pre-tax basis, both catch-up and regular contributions. And if you have anything extra to save, yeah, do more on an after-tax basis. You can even do a special contribution where you send a check to Voya at the end of the year to fill up any after-tax money that hasn't come from your regular payroll deductions. But yeah, I mean, I would if you have some room to save more. I would put it in your 401k on an after-tax basis compared to putting it in your savings account, for example. Not only can it be applied to NUA, but it can be rolled over to a Roth. But again, if you're towards the end of your career, you're probably towards your highest income earning. I would look at actually saving on a pre-tax basis and maxing all that out before I would save on an after-tax basis. All else equal. But again, we can look at that more specifically on an individual basis. And then what about adding Voya to account after retiring? I'm not sure what that means. I'm sorry. Oh, adding to Voya account after retiring. Sorry, I misread that. You can't. The only way you can put money into a 401k is from payroll deductions. So once you are no longer working, no longer at Exxon, you can't put any more money into Voya. All right, give it another minute or two, see if any other questions come through. I think another one. Got it. So no catch-up contributions after retiring. Yeah, no, after you retire, you can't save anything into Voya. You can save into an IRA. If you have any earned income. Keyword is earned income, not ordinary income. But yeah, you can contribute to a Roth or a traditional IRA depending on your income levels. But yeah, you can't save into a 401k. IRA is a different vehicle. Still retirement account, but different. It's an individual account, not tied to a company. Different rules as far as saving into that. But yeah, the only way you can get money into Voya is from payroll deductions, special contributions at the end of the year. But key thing is you got to be working to put money into Voya. Once you retire, can't do it. Yep, you're welcome. Another one. RMDs are taxed as ordinary income, correct? Yes, RMDs are taxed at ordinary income rates. Exactly. We'll give a couple more minutes here. Oh, okay, got another one. Oh, thanks. Yep, you're welcome. All right, one more minute. I'll wrap up here. All right. I think that's all the questions. Again, feel free to reach out to us directly if you think of any others and want to set up a one-on-one meeting. And appreciate everyone's time. Thank you again and have a wonderful week.